Okay, so today we're going to finish up on corporate taxes and then get to the next topic of the class, which is externalities. So reminding you where we are in this discussion of corporate taxation, we've been stepping back through this chain of corporate decisions. And the last set of issues we're going to talk about is what you can think of as sort of broadly a choice of organizational form, which the way in which you structure your company and increasingly where you choose to locate your operations, okay? So the traditional literature on this focuses on this question of organizational form. In the US in particular, firms can choose to organize themselves as C corporations, which are subject to the corporate tax, which we've spent a lot of time discussing, the dividend taxes, corporate profits taxes, and so on. Or you can structure yourself as an S corporation where it's basically like you're treated as an individual running a business and you're just subject to individual income taxation like you would be on your labor earnings. So the trade-off between the choice of being a C corporation or an S corporation is quite similar to the trade-off between choosing whether you finance yourself using debt or equity, which we talked about in the last lecture, and basically a similar set of puzzles arise. So because corporations are subject to both corporate profits tax and taxes upon payout through the form of dividends or interest income tax, it turns out to look like for most firms, from a tax point of view, you should structure yourself as an S corporation rather than a C corporation. And so the puzzle in this literature is why aren't all firms S corporations, just like why aren't all firms financing themselves using debt instead of equity? Here, I think there's a straightforward legal answer to some extent, which is there are legal limits to institutional ownership if you're an S corporation. So in particular, an S corporation can't have more than 100 shareholders. And so naturally, that limits your ability to raise equity from a broad set of people if you structure yourself as an S corp. So we think that's one major reason that firms are C corporations rather than S corporations in practice. Now, but there's still a trade-off, right? And so as I was saying before, like in the context of Danny Yeagan's paper on thinking about investment responses, there are firms that are in fairly similar lines of business and are quite big that are either S corps or C corps. So I gave the example of Menards versus Home Depot, both major housing supply chains that have chosen to organize themselves differently. And so we think that there are some firms on the margin, and so if you have differences in tax rates, that can lead to inefficiency. In particular, we have too many firms who choose to become S corps, and as a result might, be using external capital less than they should or less than they could if they were C corps, right? We're basically distorting the decision to become an S corp and have a small number of shareholders and have a limited amount of external funds. Yeah. No. If you're a C corporation, you pay corporate taxes on all the profits that you earn, right? If anything, you want to have your end structure be an S corp so that you end up avoiding the corporate tax. So you'd have to do the reverse, which I think would actually be infeasible. You wouldn't, as a C corporation, want to own an S corporation because then whatever profits the S corp earns would be subject to the corporate profits tax, which is exactly what you're trying to avoid. So it's the opposite direction, but then you're limited in the number of shareholders you have. So I don't know exactly how it works, but I don't think you'd be allowed to have like a subsidiary where you're raising external capital from lots of people and have that be part of an S corp and be legal with this 100 shareholders limit. So there's an empirical literature on this that goes back quite a long time, very similar to the other literatures I've talked about in this context, showing that there's a correlation between corporate tax rates and the fraction of assets in corporate form in the time series. Okay, so for example, this paper by Mackey, Mason, and Gordon in 1997. But again, I'm not going through this work in detail because I think the challenges from a modern perspective are the same as in the debt versus equity discussion. So first, we don't have very much quasi-experimental evidence on how these taxes affect the choice of organizational form. So that's one limitation. But second, and I think perhaps more importantly, what we care about at the end of the day, as I've been emphasizing in these corporate finance lectures, is not just how you choose to label your company, but what the end-line real impacts are. So how does the fact that I distort people to becoming S corps, does that make them invest less? Does that make them hire fewer people? Does that affect economic growth at some broader level? That's what we really want to get after, right? And I think there we have much, much less evidence than we'd like, so that's very much an open question. And then I think those two things, getting better quasi-experimental evidence both on finance and on real impacts, ultimately feeds into an optimal tax question, which can be thought about in the context of modern corporate finance models rather than the neoclassical models where the manager is maximizing the value of the firm, which is again something that hasn't really been explored. So what are the types of questions that might arise? So why are we giving S corporations preferential tax treatment? Well, one reason you might think that's sensible is if you think there are cash flow constraints as in modern corporate finance models, then you might think you want to give startups a tax break so that they can use all the capital they have to invest and grow and so on. And then the question becomes, are preferential treatment of S corps the best way to do that? Or is there some other tool that's better, right? So as I was saying, there are S corps that are actually quite big, and so it's not obvious that they're really startups that you need to be giving preferential tax treatment to. So maybe there's a way to target it better. Yeah. No, I think the undistorted world is one where you are making this choice between S and C corp in a way that's not affected by taxes, right? So some firms are going to choose to organize themselves as S corps versus C corps in a way, in a certain way. There's going to be a certain equilibrium in a no tax situation, right? And any deviation we have from that because of taxes, we think of as a distortion because they're, the social costs are the same and we're just distorting that by the tax system, right? There's a trade-off, right? So even in a world without taxes, some firms are going to say, I prefer to, to be in, well, I mean, I guess you're right. If there's literally no tax cost to being a C corp, you might as well be a C corp with fewer restrictions. I'm not familiar with enough with it to know if there's something else about S corps that would make them attractive as a way to set yourself up independent of taxes. Yeah, but that's right. I mean, I think that's the right way to think about it. Yeah. No, that's totally right. It's basically what you're saying is the distinction between these two forms of corporations is also a government rule. And so it doesn't really make sense, you're right, I think, to think about tax policy independent of how you're setting that regulation of 80 investors or something else. I think that's right. Yeah, so I mean, I think that trade-off is similar to, it's analogous to this trade-off, right? I would think if you feel like you have a lot of equity on your own and you don't feel that you need to raise a lot of capital from external markets, then you have the luxury of being able to set yourself up as a sole proprietorship and not subjecting yourself to higher corporate tax rates. And so presumably it's those types of more well-capitalized companies that end up being set up in that way. That would be my guess. I don't know if there's system. I'm not sure that's right? Because you can retime your profits to some extent as well. You're right that you can't change your stream of payouts, so that's correct. You can't, like corporations have this important margin of retaining earnings versus paying dividends. And so like suppose the dividend tax cut is temporarily low, I can pay dividends at that time to take advantage of that. For firms treated under the individual income tax code, you don't have that payout distinction. You're taxed on whatever profits you earn under the individual income tax code. But I think you still have scope to manipulate when you realize profits to some extent. I don't know enough about the accounting details of exactly how that would happen. They're just shelter income in corporations, right? And never pay anything out. Yeah. 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 And I think that that's correct. We're going to see a parallel to that with the international tax stuff that I'm going to talk about in a minute, where if you can just keep your money within the firm and never pay it out and in effect benefit from it, like coming back to the example I was giving earlier where, suppose a physician sets up his business as a corporation and basically declares as costs the cars that he uses or whatever else. You can, in effect, avoid any taxes by just keeping the money within the corporation. So that's right. I mean, I think that's a potential rationale for, that's why you can't just have an individual income tax. What you're getting at also relates a little bit to the deeper question, which I haven't said anything about, of why we have a corporate tax at all, right? So you could think, at the end of the day, corporations are owned by individuals. So why do we bother taxing corporations as an entity? Why don't we just have an individual income tax on the payouts paid by corporations and so forth? And I think from like a standard economic model where there's no scope for evasion and everything's totally neoclassical, you actually would find that the two things are equivalent because you might as well just levy it on the end recipients of the stream. But if you have exactly the phenomenon you're describing where you can keep the money within the firm and evade and effectively get those benefits without ever making a payout, you need to have a corporate tax. Yep. Okay, so now, I think traditionally people focused a lot on this organizational form question within the US, but increasingly, and probably the most active part of this literature now, I would say, is the international tax dimension. It's a very important topic from a tax reform perspective. So the US has what's called a worldwide tax system where you pay US tax on your profits only when you bring your money back to the US, okay? For instance, if you want to pay dividends to your shareholders. So in order to pay dividends to your shareholders, you need to bring the money back to the US and then you pay it out as dividends and you're subject to the US corporate profits tax as well as the dividends tax. Now the key thing is that the repatriations, that's what's called when you bring money back to the US, they're taxed on the difference between the tax rate where the profits are earned and the US corporate tax rate of 35%. So to take an example, suppose you make a profit of $100 in Ireland, where people estimate that roughly the average corporate tax rate is 4%. So Ireland has tried to set itself up to get a lot of profits by having a very low corporate tax rate and get a lot of business. That's supposed to be the idea. What would happen when you bring that $100 back to the US? Well, we'd say, you've already paid $4 in Ireland. We're going to give you a credit for that. And you're going to have to pay $31 to us now because our corporate tax rate is 35%, okay? Now, what incentive does that create? It creates a strong incentive to, at the least, report profits in Ireland, right? And hold your money in Ireland as retained earnings in these foreign tax havens where you're subject to lower tax rates, right? It creates a strong disincentive to bring the money back to the US, and possibly it also creates more of an incentive to set up your business operations, your real activity in these other countries with lower tax rates, right? So one way you can see the importance of that is just by looking at the cross-section of where profits are earned in the world, right? And so if you just naively look at which economies seem to be the most successful in terms of having really high profit rates, you would conclude that like the most profitable places in the world are the Netherlands, Ireland, Bermuda, and all these other relatively small countries typically, right? Which when you look at that graph, you can see it seems quite inconsistent with where you think production is actually occurring, right? We don't think of like a tremendous amount of employment and investment occurring in Bermuda, for example. So what is going on? So how do firms realize such high profits in Bermuda when they don't actually seem to have like a huge amount of infrastructure in Bermuda? So the typical way you would do this, and there's a lot of complicated accounting here to make this work, but as a rough example, you set up a subsidiary. So suppose you're like a big multinational firm, right? And you set up a subsidiary that provides some service to your firm, like let's say accounting services, that's in Bermuda, right? And you sell that service to yourself at an incredibly high cost. So that reduces your profits that you earn, say, in the US, because you had to pay this really high cost for accounting services, right? So it reduces your US profits and it increases your profits on this very profitable accounting services division in Bermuda. So effectively, you're shifting your profits out of the US to the tax haven, right? So that's very naive way probably to do it, and the government would crack down on something that simple. And the way we try to do that is by what are called transfer pricing rules, which basically try to prevent a transaction like this by saying you have to price these transactions within a firm at the same level that you'd price arm's length transactions at the same level as the market would price them for like a transaction between two companies if you were to actually buy accounting services from a different guy. Now the problem is that's very hard to enforce in practice, especially if you have sort of exotic products where it's hard to market to market. Then I end up having quite a bit of scope to manipulate what I report as the true price of these services, and so then that's how you end up with the lot of profits being realized in tax havens. Now, moreover, what really compounds this problem is not merely that you can realize your profits in Bermuda. Like this per se would not be a huge deal if you had to bring your money back to the US regularly, right? Because you'd have to pay the corporate tax when you repatriate the profits. But what compounds this problem is that you can then, if you have a subsidiary, use the money that's being held in Bermuda to invest in operations around the world without repatriating the money back to the US. So that's actually critical because it allows you to grow your multinational business without ever paying corporate profits tax in the process, right? So I can basically build up a lot of retained earnings and keep investing. It's like I defer my taxation for a long time until I finally bring the money back to the US, right? So it basically allows me to earn a lot of profits without paying any corporate profits tax and keep investing and compounding my rate of return with no 1 minus tau c, and then only pay the 1 minus tau c at the end when I bring it back. But even there, as we'll see, you might expect not to pay that corporate profits tax because the US from time to time has these tax holidays that allow you to bring the money back without paying corporate profits tax. And so you might actually have a reasonable expectation that if I keep the money in Bermuda and keep investing like that, maybe I'll be able to time it so that I'll never pay the corporate profits tax, okay? So this is obviously like a huge problem for the US, both because we're directly losing a lot of revenue, right? And so there's a potential base that we want to collect revenue from. So that's just like a shifting revenue collection issue. But then moreover, I think we're especially worried about it if, unlike the Bermuda example, but maybe more like the Ireland example, we're worried that actual production and jobs are shifting overseas because of tax competition, because of the fact that other countries are continuously offering lower tax rates, right? Okay, so the question naturally, empirically, is how much do firms actually shift reported profits in response to local tax rates? So I'm going to talk about two papers here, one from the older literature by Hines and Rice that's quite influential, and then a more recent paper that takes more of a quasi-experimental approach. So Hines and Rice estimate the impacts of tax rates on declared profits, and they do a very simple exercise that kind of kicks off this type of empirical work, which is to regress the declared profits of US multinationals on local tax rates in a sample of tax havens and other countries, okay? So take a sample of countries excluding the US, right? And ask, do we see higher declared profits in countries like Bermuda, which have very low tax rates relative to, some other country like Switzerland, which might have higher tax rates, right? So in order to estimate the causal impact of a change in a country's tax rate on declared profits, what orthogonality condition do I need for this research design to work? I need it to be the case that this variation in tax rates is orthogonal to other factors that might affect business location decisions, right? So most obviously, maybe Bermuda doesn't just offer you low tax rates, but it's also less regulated, and there are other benefits from locating in such places, right? And I think there's reason to believe that this occurs, right? So these tax havens set themselves up to be not just low tax rate places, but also convenient places to do business. And so you might think that this OLS regression is going to overstate the impact of simply changing your tax rate and not changing anything else. But it's a good place to start. And so their conclusion, as we can see from this table here, and I'm just going to focus on the first column, is just OLS regression across countries of declared profits on tax rates measured in percentage points, and it's log profits on the left-hand side, and we see that a 1 percentage point increase in the tax rate reduces declared profits by 3% in this OLS specification. Okay, so a fairly large effect. If you think, Bermuda has 20 percentage point lower tax rates than another country, you can see why it has massively more declared profits than other countries. Okay. Now, the problem with that simple approach, as I said, is that we're not confident it purely captures the effect of tax rates, right? So a more recent paper that I think illustrates the type of quasi-experimental work that would be useful in this context and also gets at some of the real impacts is this paper by Dharmapala, Foley, and Forbes, where they study intertemporal substitution in the repatriation of profits. So while you might think of the Hines and Rice paper as estimating like a steady state Marshallian elasticity, it's more appropriate to think about this paper as estimating something that looks more like a Frisch elasticity or an intertemporal substitution elasticity. So what they study is the Homeland Investment Act of 2004, which provided a one-time tax holiday for the repatriation of foreign earnings by US multinationals. So this policy was enacted as a one-time policy, right? But when you enact such policies, you have to be very careful because they have reputational effects. And so when people know that from, every 10, 15 years, the US does this, you're going to have that expectation that I should keep my profits in Bermuda so that I wait till 2020 when we decide to do this thing again, right? So while it's correct to think about this as a one-time change, I think it has dynamic effects on behavior. So what was the goal of the policy? The stated goal by people in Congress, where they have some nice quotes in the paper, was that this policy would increase investment and create jobs in the US by bringing money back home, right? And a lot of corporate lobbyists made exactly that claim that, this is really important to increase job growth in the US. So what's the implicit logic there? It's kind of a cash flow constraint logic. If US multinationals' domestic activity is financially constrained by the amount of cash they have in the US, then repatriations would increase domestic employment and investment, right? If in contrast capital markets are perfect and I can borrow freely within the US and I'm not really constrained, then you're in a world where there are no income effects for the corporation, right? And so bringing cash back to the US should not really affect your decision to invest or employ people because you're just equating, you're just following a price optimality condition there without thinking about the amount of capital you have. So, so that's what they focus on. And then more generally, the paper provides good quasi-experimental evidence on the financial and real impacts of international tax havens. All right, so how does this work? They're going to use a diff and diff design with a variable intensity of treatment. Okay, so in particular, they're going to exploit the fact that there's variation across tax rates in countries where companies reported profits prior to the reform, right? So think of it as one company, like let's say Coke, was harvesting a lot of profits in Bermuda, and another company was harvesting a lot of profits in the Netherlands, and let's say they have different tax rates. They're both tax favored, but one of them has an effective tax rate of 0 and the other one has an effective tax rate of 15% or something like that, okay? Now, companies with profits in in countries with low tax rates, that is the real tax havens, they have a very large change in tax incentives from the Homeland Investment Act, right? So if I have my money in Bermuda, bringing it back to the US is going to trigger a huge tax liability normally. So the Homeland Investment Act makes it really attractive for me to bring back the money at this particular time in 2004. If in contrast I have my money in, say, Switzerland, which has a tax of 20%, then I only pay an extra 15 cents when I bring it back home. And so the net gain from the Homeland Investment Act is a smaller reduction in the effective corporate profits tax, right? Because I would have paid a tax of 15%, now I'm bringing that down to 0, whereas for the guy in Bermuda, I would have paid 35%, and I'm bringing that down to 0. Yes, so I think you should, so let me say two things on that. So first, I agree with that worry, but their design is not going to be just a pure cross-sectional comparison of these different companies, right? They're going to look at changes around 2004. So as long as the change around 2004 would not have been different across those two types of companies, you're going to get an internally valid estimate. But the second point that your question raises is that, I think based on what I said, you're going to get a valid estimate of a local average treatment effect for these guys who are using the tax havens. But you're right that you're not going to get the average treatment effect for the full universe of firms that, may or, some who may not be using these tax havens and so on. But I would argue that from a policy point of view, this is a case where you might actually care about the local average treatment effect because you want to think about the effects of these tax policies on the guys who are actually using the tax havens, right? But see, the issue is it's not so much an ability to move to Bermuda. It's not, that would maybe make sense if it was real activity that was shifting. But I think a lot of this shifting is not, it's going to be really hard to make Coke in Bermuda. It's Coke sets up a subsidiary that does some thing that then ends up allowing it to realize its profits in Bermuda, right? So it's hard to know, like you wouldn't be able to say this guy in the computing sector is not going to be able to shift its profits, whereas the some other sector is. It's hard to imagine how you would make that work. So that's a good, right, so that's right, and that's actually something Alan Auerbach has been discussing recently. So it's not that they're getting an exemption for that, it's that they're saying they're paying costs, they're incurring this cost for this accounting service that's very expensive, and that's reducing their US profits. And so why does that work? Because the corporate profits tax base is based on all revenues minus all costs that you incur, whether in the US or abroad. And so one of Auerbach's recent proposals is we don't let you deduct costs that are incurred abroad. We only let you deduct costs incurred within the US. That would eliminate the incentive to do this type of thing. So that's a possibility. And one could think about what effects that might have and so on. All right, so let's see. Let's see what happened here with the Homeland Investment Act. So the first thing you can see just in the raw time series, total amount of money brought back to the U.S. by these corporations. On the surface, it looks like the Homeland Investment Act was incredibly successful in its stated goal, in that you get an extra $300 billion back when the thing was in effect relative to afterward or before, right? So it's clear that there's a raw effect on total repatriations. Moreover, you can see that their research design works as well on this first stage. So as I was saying, they split firms into those with low benefits from the tax holiday and high benefits from the tax holiday, right? So these are the guys in Bermuda with the high benefits from the tax holiday, and these are the guys, say, in Switzerland with the lower benefits from the tax holiday. And you can see that, in fact, as you would expect, the guys who are doing a lot more repatriation, they're accounting for almost the entire increase, are the people who had their money in these tax havens like Bermuda. They're bringing it back to the US. So that's a purely financial issue, right? It's not terribly surprising that when you lower the tax rate to 0, people bring the money back to the US. The question that is of great interest and that they're after is, did that actually achieve the stated goal of increasing capital expenditures in the US, employment in the US, or research and development in the US, and so on? And the answer, I think quite convincingly, using this research design, right? I'm going to focus on the right pair in each of these cases, the right column. So that's the IB specification where they're instrumenting using this difference. They're basically using this research design to generate variation in repatriations, right? They're using that diff and diff indicator as an instrument. What does this coefficient mean? So the dependent variable is capital expenditures over lagged assets, and they're basically saying that there's no detectable change in the amount you're investing in the US for every dollar that you repatriate. It has less than a 1 cent effect. Every dollar that you bring back, the point estimate is you change investment by less than $1. You also don't find any evidence that there's a change in the total number of people on your payroll or your the size of your payroll, although that's estimated somewhat imprecisely. You don't see an impact on R&D. Where do you see clear effects? On payouts. So every dollar that you bring back, instrumented by this, the diff and diff indicator, every dollar you bring back leads to 92 cents of higher payouts, 15 cents of which seem to come from dividends, 80 cents of which seem to come from more repurchases of shares. So what's the idea? We bring $300 billion back to the US, but we don't directly invest that money or hire more people. Instead, we pay that money back to shareholders by buying back a lot of shares and increasing the amount of dividends we pay, which at least, from a partial equilibrium point of view is totally inconsistent with what the aim of the policy was, right? Which was to get these companies to invest more. So their conclusion is that tax breaks on repatriations don't actually affect domestic investment or employment by affected firms. Instead, they affect payouts. Should you conclude from that this has no real impact? Well, that's a little bit trickier, right? Because it depends upon what happens with the cash returned to the shareholders. When the shareholders now have an extra $300 billion, they're presumably going to do something with that. And if they invested that in the US economy, like let's say started new businesses in the US, that does have a real effect. And so that general equilibrium effect, in a sense, is not captured, obviously, by this partial equilibrium analysis, but one would want to take that into account when thinking about optimal policy. Yeah. Yeah, that's a good point. And maybe that actually makes sense, that you'd want to time these types of tax holidays, if you're going to do them, to points like recessions where companies are cash constrained. Yeah. I think in general, people feel like these tax holidays are not a good idea because they basically create this view that we're effectively not going to impose corporate taxes because you can just time it so that you bring it back at a point when it's zero. But if you're going to do it, that makes sense. But so what makes you say they behave as if they're cash constrained when they pay dividends?
Well, when they bring the money back, they pay out higher dividends.
Oh, I see. So you're basically saying, why is the marginal propensity to spend out of the dollars that I bring back? I mean, I've got to do something with the money, right?
Well,
You could just sit on the cash.
Right, you could sit on the cash in the United States.
You could sit on the cash in the United States. I guess one way to think about it, so here's a possible explanation. So suppose I'm able to invest in the US, capital markets are good enough such that I'm not constrained on the margin. Like if I see a good project, doesn't matter if my money is locked up in Bermuda, I'm able to raise capital to get to the efficient level of investment. So now when I bring money back, that's not going to affect my marginal investment decision, right? But shareholders might want their money back, right? And so it makes sense for me to return the money to the shareholders on the margin. That's basically the type of model that would generate this. Okay, so wrapping up, I think the bigger picture questions here are, what are the implications for optimal taxation? In this context, they're giving you a picture of the high frequency substitution. I think what we want to know more generally is whether taxing foreign source income, coming back to this question of whether you should be allowing people to deduct expenses incurred abroad and so forth, should we be making an effort to tax foreign source income at all, or should we just kind of say, like, whatever you earn abroad, we're not going to deal with that in the US and subject it to US taxes, and maybe we're not also going to allow you to deduct foreign expenses, so that would be a different way to structure it. More generally, I think what people are interested in is, this is a case where tax competition, this game that various countries are playing, especially smaller European countries, seems like it might be reducing aggregate welfare because everyone is trying to cut corporate tax rates and attract the profits to their area, and nobody's able to tax corporate profits. So how do you prevent that? How do you think about optimal policy in that context of a game being played across countries and so forth? I think all of these are interesting questions that remain to be explored. Okay, so any other questions? Okay, so that's it on the corporate tax stuff, and we're going to move on to externalities.